The controlled demolition of the dollar has begun, the Fed's secret gold strategy exposed. What if the decline of the world's most dominant currency was not a gradual erosion, but a controlled demolition? We are witnessing a seismic shift in the global monetary order, a transition so profound that its architects are deliberately obscuring it behind market volatility and political theater. For nearly a century, the U.S. dollar has been the bedrock of international finance, a privilege that allowed America to export its inflation and finance its deficits. That era is definitively over. The world has crossed a critical threshold where less than half of global reserves are now held in dollars, a clear signal that the world's central bankers are quietly hedging against a future where the dollar is no longer king. This isn't a forecast, it's an observation of a process already in motion, a silent restructuring for a new financial system. The core problem we face is a global financial architecture built upon a foundation of sand, debt-based fiat currency. The current system's survival hinges on maintaining confidence, an illusion of stability that is becoming increasingly difficult to sustain under the weight of unprecedented sovereign debt. The primary mechanism for preserving this illusion is the active, calculated suppression of the only true barometers of financial distress: gold and silver. When the prices of these timeless monetary metals rise, it signals a flight from fiat currency and exposes the dollar's intrinsic weakness. This is not a reflection of prosperity, but a stark warning of systemic fragility, a vote of no confidence in the promises of governments and central banks to manage their ledgers responsibly. The manipulation of precious metals markets is not a conspiracy theory. It is a documented operational strategy. The arena for this battle is the commodity exchange, or COMEX, where paper derivatives are used to overwhelm the physical market. A handful of major financial institutions, the so-called Big Four banks, hold gargantuan short positions that defy logical hedging strategies. These are not tools of price discovery, but weapons of price control. By flooding the market with paper, gold, and silver, they can artificially cap any rally, protecting their own massive derivative books and, more importantly, defending the perceived strength of the U.S. dollar. This is a decades-long practice that distorts the true value of money and conceals the deep structural problems festering within our financial system. The timing of these market interventions is often brazenly opportunistic. We consistently observe the most aggressive downward pressure on gold and silver prices during periods of low liquidity, or when regulatory oversight is diminished. A government shutdown, for instance, which places the Commodity Futures Trading Commission, CFTC, on temporary leave, becomes an open invitation for these banks to engage in blatant short covering and price slams. This isn't the invisible hand of the market at work. It is the heavy hand of powerful, interconnected players executing a coordinated strategy. The fines occasionally levied for this behavior, such as the nearly billion-dollar penalty paid by J.P. Morgan, are treated as a mere cost of doing business, a pittance compared to the immense profits generated from the manipulation itself. The ultimate question is not whether this manipulation occurs, but on whose behalf it is conducted. While these banks profit handsomely from their proprietary trading, they also act as commercial agents for larger, more powerful entities. The primary clients who benefit from artificially low gold prices are the very institutions that have the most to lose from a dollar collapse: sovereign governments and their central banks. The U.S. government and the Federal Reserve are the largest holders of U.S. treasuries and thus the prime beneficiaries of a system that masks the dollar's decay. They are not merely passive observers, but the silent partners in a scheme designed to prolong the lifespan of a dying monetary system, buying precious time to prepare for its replacement. This controlled suppression is a global affair, a grand piece of kabuki theater where even geopolitical rivals play their designated roles. Nations like China and Russia, while publicly championing de-dollarization, are also major holders of U.S. treasuries. A sudden, chaotic collapse of the dollar would inflict catastrophic damage on their own balance sheets. Therefore, they are participants in this managed decline, using the suppressed price environment to aggressively accumulate physical gold from the West. They understand the end game. They are systematically converting their paper dollar reserves into tangible monetary assets, preparing for the day when the system is reset and the chips are counted based on physical holdings, not paper promises. The primary catalyst for this global monetary reset is a seemingly arcane piece of banking regulation known as Basel III. Finalized by the Bank for International Settlements, the Central Bank of Central Banks, these new rules fundamentally change how gold is treated on the balance sheets of commercial banks. For the first time in decades, physical gold is officially reclassified as a Tier 1 high-quality liquid asset, placing it on par with cash and sovereign bonds with a zero-risk weighting. This is not a minor technical adjustment. It is a revolutionary act of remonetization. It signals to the entire global banking system that gold is no longer a fringe commodity, but a core component of financial stability, a foundational asset for the coming era. The implications of Basel III are profound. By granting gold this elite status, the world's top financial regulators have given central banks the green light to accumulate it without penalty and use it as pristine collateral. It legitimizes the very strategy that nations like China and Russia have been pursuing for years. While public attention is diverted by mainstream financial news, a quiet arms race for physical gold is underway among the world's monetary authorities. They are using the very commercial banks that suppress the paper price to acquire the physical metal at a discount. This is the great irony. The tool of suppression, the paper market, is being used to facilitate the transfer of real wealth into the hands of those who will write the rules of the next system. Parallel to this remonetization of gold is the development of the technological infrastructure for its replacement. Central Bank Digital Currencies, CBDCs, and digital identification systems. This is the second major catalyst driving the transition. CBDCs represent a quantum leap in financial control, moving beyond mere digital transactions to programmable money. A CBDC is a direct liability of the central bank, allowing for the direct implementation of monetary policy on an individual level. This could include negative interest rates on savings, expiration dates on funds to force spending, or the restriction of purchases of certain goods and services. This technology is not a distant concept. It is in advanced testing and beta phases in dozens of countries, including pilot programs within the United States. A CBDC framework cannot be fully implemented without a comprehensive system of digital identity. To control the flow of programmable money, the issuing authority must have a foolproof way to identify and track every participant in the economy. This is why the global rollout of digital IDs is proceeding in lockstep with CBDC development. In some nations, these systems are already becoming mandatory for basic economic participation, such as holding a job or accessing a bank account. In the US, the groundwork is being laid through the digitization of state-level IDs, like the Real ID licenses, which are being quietly linked to create a national database. The goal is to merge an individual's financial, medical, and social data into a single, state-controlled profile. The convergence of these catalysts, the systemic weakness of the dollar, the remonetization of gold under Basel III, and the imminent rollout of CBDCs and digital IDs, is creating the conditions for a financial tipping point. This will not be a singular explosive event like the 2008 crash, but rather a carefully managed and sequenced demolition. The current system will be allowed to persist just long enough for the new architecture of control to be fully operational. The suppression of gold and silver buys the necessary time for the powerful to finalize their preparations, and for the public to be gradually acclimated to the idea of a purely digital, state-administered financial existence. The tipping point will be reached when the major global players have accumulated sufficient physical gold and have the CBDC infrastructure ready for a mass rollout. At that moment, they will no longer need to defend the US dollar. They can allow its value to seek its natural, much lower level, or even trigger its demise. This could be initiated by a major creditor, like China, finally dumping its US Treasury holdings, an act they have thus far refrained from because the timing was not right. When they are ready, they will pull the plug, creating a currency crisis of unprecedented proportions that will serve as the perfect justification for the introduction of the new, more stable digital system. The trigger for this event will be framed as a solution to an inescapable crisis. The narrative will be one of necessity, that the old system of debt has failed and a great reset is required to restore order. This is when the true value of the accumulated gold reserves will be revealed. With the dollar and other fiat currencies in freefall, governments will announce a revaluation of their gold holdings to a much higher price. This is not a novel idea. It is a well-worn page from the historical playbook of monetary resets. A massive upward revaluation of gold would instantly repair the shattered balance sheets of central banks and governments, providing the collateral needed to back the new digital currencies. This revaluation will effectively serve as a global debt jubilee, but one that benefits the debtors, the governments, not the creditors. The astronomical national debt, currently unpayable, could be extinguished or collateralized against these newly valued gold reserves. For the public, this will be sold as a necessary and even beneficial step to wipe the slate clean. However, the price of this bailout will be the mandatory adoption of the new CBDC and Digital ID system. The old, failing fiat money in people's bank accounts will be forcibly converted into the new programmable currency, and participation in the economy will be contingent on accepting the terms of this new digital framework. The immediate impact of this transition will be a stark bifurcation of wealth and freedom. Those who hold tangible non-digital assets outside the banking system, primarily physical gold and silver, will see their purchasing power preserved and likely multiplied overnight. These assets are anonymous, censorship-resistant, and cannot be programmed or devalued by decree. They will represent true financial sovereignty in a world of absolute financial control. For the vast majority who hold their wealth in digital bank deposits, stocks, and bonds denominated in the old fiat currency, the transition will be devastating. Their savings will be forcibly converted into a system that offers convenience at the cost of autonomy. Life in the aftermath under a mature CBDC regime will be fundamentally different. The very concept of money as a private, fungible tool of exchange will be obsolete. Every transaction will be recorded on a central ledger, monitored and approved by the state. This creates the potential for a social credit system, where financial access can be throttled or denied based on behavior, political views, or compliance with government mandates. The distinction between the fiscal and monetary authorities will dissolve, giving the government unprecedented power to directly manipulate the economic lives of its citizens. This isn't merely a new payment technology. It is a new and far more invasive model of social and economic governance. The geopolitical landscape will be redrawn in the wake of the dollar's collapse. Global power will no longer be projected solely through military might or the privilege of issuing the world's reserve currency. Instead, influence will be determined by a nation's holdings of tangible monetary assets, its technological prowess in the digital currency space, and its control over critical resources. We will likely see the emergence of competing blocs, perhaps one centered around a Western, IMF-led digital currency and another around a BRICS-led alternative, possibly with some form of commodity or gold backing to lend it credibility. The unipolar moment of American financial dominance will be replaced by a multipolar and far more volatile world order. The role of gold will be paradoxical in this new world. While it will be the foundational collateral that enables the reset, it will be simultaneously sidelined from public use. Governments will hoard it and use it to settle international balances, but they will actively discourage its use as a day-to-day medium of exchange among the populace. The goal is to herd everyone into the digital enclosure of the CBDC system. Gold's true price will be realized, but its utility for the average person will be in its one-time conversion value, a life raft to get from the old system to the new, rather than as a circulating currency. The free market for gold may be driven underground, becoming a tool for those who choose to operate outside the official system. For individual investors and savers, the immediate aftermath will require a radical rethinking of asset allocation and risk. Traditional safe haven assets like government bonds will have been exposed as unsecured promises from bankrupt entities. The stock market will face extreme volatility as corporations grapple with a completely new monetary reality. The value of assets will be increasingly measured not in nominal currency units, but in their ability to provide utility, generate real returns, and resist confiscation or digital control. Real estate, productive land, energy resources, and of course, precious metals will form the cornerstone of any resilient investment portfolio. The long-term impact on society could be a gradual erosion of economic dynamism and individual liberty. A centrally planned monetary system, where capital can be allocated and restricted by decree, stifles entrepreneurship and misallocates resources. The constant surveillance inherent in a CBDC world could create a chilling effect on dissent and nonconformity. The promise of efficiency and security offered by the new system will mask a deeper reality of servitude to a technocratic elite. The fight for financial freedom will become synonymous with the fight for personal freedom, as the ability to transact privately and hold wealth securely becomes a primary front in the battle against authoritarian overreach. The great takeaway from this unfolding drama is the urgent need to understand the fundamental difference between currency and money. Currency is a government-issued liability, a debt-based instrument whose value depends entirely on the trust and creditworthiness of its issuer. Throughout history, all fiat currencies have eventually returned to their intrinsic value, zero. Money, conversely, is a tangible asset that is no one's liability. It has value in and of itself, derived from its scarcity, durability, and millennia of acceptance. Gold and silver are the ultimate forms of money, assets that have outlasted every empire, government, and currency experiment in human history. This understanding must translate into action. The persistent suppression of precious metals prices should not be viewed as a source of frustration, but as a profound and rapidly closing window of opportunity. It is a gift of time, allowing prudent individuals to exchange their depreciating paper and digital currency units for real, timeless money at an artificially low cost. Every dip in the price of gold and silver caused by paper manipulation on the COMEX is a subsidy for those who are awake to the reality of the situation. This is the chance to opt out of a system that is designed to fail and to build a personal financial foundation on an asset that cannot be printed, debased, or centrally controlled. Preparing for this transition is not about cheering for a system collapse. It is about building a personal lifeboat in calm waters. A chaotic, uncontrolled crash would be disastrous for everyone. The goal is to achieve financial resilience so that one can weather the inevitable storm and preserve purchasing power through the reset. This means prioritizing the acquisition of physical assets over paper promises. It means reducing dependence on a fragile and increasingly weaponized banking system. It means educating oneself and one's family about the nature of money and the historical precedents for the events that are now unfolding before our very eyes. It is also crucial to recognize the interconnectedness of financial and personal freedom. The rollout of CBDCs and digital IDs is not merely a financial event, it is a political and social one. It represents a significant step towards a society of greater surveillance and control. Resisting this future requires more than just buying gold. It requires advocating for privacy, supporting decentralized technologies, and opposing the mandatory implementation of digital identity systems. The battle for the future of money is a battle for the future of individual autonomy. Financial independence is the bedrock upon which all other freedoms are built, and that independence is precisely what is under threat. Looking forward, the timeline for this reset is accelerating. The original target for a widespread rollout of these systems appeared to be closer to 2030, but recent geopolitical and economic pressures suggest a revised schedule, perhaps as early as 2028 or sooner. The speed at which digital IDs have been implemented in numerous countries, and even within several U.S. states, is a clear indication of the urgency behind this agenda. The political theater and manufactured crises we see in the daily news cycle often serve as distractions, keeping the public's attention focused elsewhere while the foundational elements of this new system are cemented into place behind the scenes. The coming revaluation of gold will be a moment of truth for the global economy. It will be a public admission that the 50-year experiment in pure fiat currency has failed. The price at which gold is reset will be a political decision, not a market one. It will need to be high enough to sufficiently recapitalize the system and deal with the colossal overhang of debt. Estimates vary wildly, but the mathematical reality suggests a price many multiples of its current level will be necessary. This will not be a windfall for everyone, but a dramatic repricing of all assets relative to real money, exposing the true losses that have been hidden by decades of inflation. The future financial system will likely be a hybrid one, at least initially. Gold will serve as the trusted, neutral settlement asset between central banks, the bedrock of the international system. Domestically, however, the population will be forced to transact using the state-controlled CBDCs. This creates a two-tiered monetary system, one for the elites and the state based on real assets and another for the public based on digital control. The illusion of wealth will be maintained for the masses through their digital accounts, but true, sovereign wealth will reside in the physical vaults of the world's central banks and the hands of private individuals who prepared in advance. Ultimately, the lesson is one of cycles. The global monetary order is not static. It evolves and occasionally it is reset. We are living through one of those historic pivot points. The shift from a dollar-centric debt-based system to one that is multipolar and asset-backed is already underway. The desperation behind the manipulation of gold and silver markets is the clearest evidence of the system's fragility. The architects of the new world are not trying to save the old one. They are steering the Titanic through the ice field, trying to get their own lifeboats in order before the inevitable sinking, all while telling the passengers that the music will play on forever. The path forward for the individual is clear: become your own central bank. This means acquiring assets that function as a store of value independent of the promises of any government or financial institution. It means diversifying away from assets that are purely digital or held within a system that can be frozen or confiscated at the push of a button. The coming years will be defined by a great wealth transfer, moving from those who trust in paper and digital promises to those who hold tangible, sovereign assets. The choice is between being a passenger on a sinking ship or the captain of your own financial destiny. In conclusion, we are not on the brink of a financial shift. We are in the midst of it. The frantic efforts to suppress gold and silver are the last gasps of a dying system, a desperate attempt to maintain an illusion of control. But behind the curtain, the real players, the central banks and major economies of the world, are playing a different game. They are accumulating real money in preparation for a new system, one that will be built on the foundation of revalued gold, but managed through the digital control of CBDCs. The greatest risk is not in recognizing this reality, but in ignoring it. The time to prepare is now, while the illusion of normalcy still holds and the window of opportunity remains open.